Howdy, Jacob here. Today I'm going to be looking at a more in-depth review on EBIX, ticker symbol EBIX. And so just a quick reminder, when we did this company, uh, market cap and enterprise value looked great, 136 million on the market cap, 47 million enterprise value. So net debt appeared cheap at the beginning, and then when we just looked at a quick glance at their balance sheet, we noticed that their long-term debt moved from long-term to short-term, which means that if you incorporate that debt into their long-term, the enterprise value is more like 700 million, so a lot higher than the market cap. We see that their dividend yield is 6.94%, looks very attractive, but can they hold that? If we just look at their cash flow statement, they pay out 9 million in on the dividend, and they can most definitely afford that with their most recent 5 years averaging probably 50 to 60 million. So they can definitely afford it there. Again, a big thing that I'm going to be wondering why, or wondering if they can get through this is that debt. And so um, yeah, I guess the first thing I want to show that I didn't show before um, is that gross margin has been going down like crazy, and operating margin has also been decreasing like crazy. 10 years ago, 80% on gross margin, 36% on operating margin, and now we're seeing 30% on gross margin, low teens on not even 11, 12 on percent on operating margin. So that's a concern. Um, They could just be changing businesses a little, like quite a bit, to less margin businesses to get growth, but I don't want that. I don't want the company to fight for their revenue growth and hinder their margins, which is kind of what they're doing, or 100% what they're doing. Second thing on the debt situation is that in the Q3 report, they said that there should be an update to the debt situation during 2023 Q4 because the company's credit facility matured on September 30th, 2023, and an alternative finance agreement has not been agreed upon. And so the agreement mandates that by October 31st, the company and the lender get their situation figured out. But basically, this is not a good sign. This is saying that the company had 600 million in debt, and they didn't have enough cash on hand to be able to pay it back, which is actually fairly common. The thing is that the lender said we're not going to, or immediately they didn't say we're going to lend to you, and so they have to try to. EBIX has to try to find alternative methods to bring the company or bring the lender enough money to where they feel comfortable either lending to them again or finding a way to pay it all outright, which would be tough since their market cap is valued at 124 million. So, anyways, the from the past few quarterly reports, the CEO is really pushing revenue growth. When I looked at uh, again all the most recent reports, the very first thing that was brought up was revenue growth, which could have just been because that was their only thing going for them. They were saying, "Oh, we had 5% growth on revenue, it was fantastic, but our margins fell 190 basis points, whatever." Um, it just to me sounded like the CEO cared more about revenue growth than really trying to push earnings and free cash flow. There was a report, or there was one sentence in I think Q2 or Q3 that of 2023 that they did say we want to push margins, but in every single report, the very first thing is revenue growth, which I was not super intrigued about. So another comment by CEO, we are fully aware that non-operating costs like the cost of debt and the advisory costs associated with it continue to hamper our overall business. We are accordingly committed to the aspirational goal of a debt-free EBIX in the year 2023. All right, so this was in Q1, and now we're here, and they haven't figured out how to pay for it. They wanted to IPO EBIX cash and use that to fund a lot of the debt. And if they got the money that they were expecting from that to use towards debt, I believe it was somewhere along the lines of 400 million. I feel like the lender would be comfortable lending 200 million given that their free cash flow is consistently above or consistently around 60 million of the last 5 years. So I feel like that would make them comfortable. But as of right now, I would definitely not be buying this company until that news came out to where we knew the company was able to refinance the debt or if they have a way of paying it off. So here is where they're saying that we intend to keep our focus on higher margin businesses in coming quarters with the stated goal of growing top line and operating income in tandem. And so recently I feel like they've just been growing top line. And so it's, I guess, good to see, being too little too late, I guess, maybe, that they're thinking about operating margins. So that's good. Uh, their interest and debt restructuring expenses were the main culprit for negative net income in the most recent period, which makes sense because their debt is very high and they've been trying to restructure it for quite a bit and it's been costing them a lot. The shares are relatively flat, so it looks like they haven't increased the share count they haven't diluted the shares to help pay for the debt, which, I mean, if worse comes to worse, might have to bite the bullet there. It's just whether they'd be attractive enough to gain enough money to help pay off a little bit of the debt. Just a quick note, international revenue accounts for over 76% of the 2023 9-month period revenue. And you can see the companies are Australia, Brazil, Canada, India, Indonesia, New Zealand, Philippines, Singapore, United Arab, and the United Kingdom. And last two notes here. So the ability of the company to continue as a going concern is dependent upon, among other things, enter new credit facility, raise additional capital, self-sufficient amount of assets of the company. So again, this is really just saying they need to figure out that debt situation, and they're going to hopefully do it in 2023 Q4. I'm not touching this until we know what is going to happen with the debt of the company, whether they can pay it off or whether they can get it refinanced. So here is just 3 questions I'm asking before you think about purchasing this company. 1, does the EBIX cash successfully IPO? So are they able to successfully IPO EBIX cash, make some money off it? Does that pay off enough of the debt to where they are able to refinance? So I know they said they wanted to be debt free. Personally, I don't think that's realistic given the IPO price that they even wanted for EBIX cash in the cash they have on hand in the earnings that they're making. I don't think that's necessarily possible. So I would say if that were possible, great. But do they have enough to pay off the debt to where they're able to refinance? And then also, what does the business look like when they IPO EBIX cash? And so there's a lot of unknowns here. I really didn't change any of the assumptions on the numbers side because it's just a waiting game at this point. Like, the numbers make sense, or buying at this price makes sense given the current estimates, but the confidence in these assumptions is very low given the fact of the credit facility lender maybe not going through, and then just what the business looks like if they were to successfully do this. So to me, I'm not changing any of the assumptions. I'm just saying, for me personally, I'm waiting. If you want to look more into it, I just don't see a way you know what the business looks like after this and if it even goes through. So I'd definitely be waiting to hear what the company does with the lending situation in 2023 Q4. So thank you, and I hope everyone has a good rest of your day.